Hi, I'm Wilhelm Hertzog, Portfolio Manager and Analyst at 3CM, and I'll be talking about 3CM's SA fund positioning, where we are excited, where we're seeing risks and opportunities. Firstly, if you look at 3CM Fund's SA equity positioning over the past 5 years, you'll see that for most of this time period there has been very little resources and mining exposure. That has changed substantially over the past 18 months or so, to the point that the resources sector is now the top sector exposure in 3CM's SA equity funds. This has purely been driven by the attractive value we're seeing in the resources sector compared to the lack of value we're seeing in domestic industrials and to some extent domestic financials. The key sector exposure within the resources sector that we have invested in is that of the platinum mining sector. And here we're seeing valuations on 30-year low types of levels. So if you look at the price to book ratio of the SA Platinum Mining Index, you'll see that it's at levels last seen in the early 1980s. This is the type of buying opportunity that comes around once in a lifetime almost, and we're tremendously excited about it. We have allocated significant fund capital of all our clients to this opportunity, and honestly, from a long-term value perspective, if you're not going to be buying platinum now, we don't know when you're going to be buying platinum. The other large sector exposure is to the gaming and hospitality sectors. And here we are quite excited about the points in the cycle where we are now. In both gaming revenue, gross gaming revenue, so on the casino side of these businesses, relative to GDP, i.e. gross gaming revenue compared to GDP, we're back at levels last seen in the early 2000s, a point in time when consumer spending in general was at very depressed levels. So we're back at very low levels, having come from very high levels in 2007, 2008. Similarly, on the hospitality side, or the tourism and accommodation side, which is a large part of the business of Sun International and Soho Sun, which are two key holdings in our client funds, you'll see that hotel occupancy levels are currently plumbing depths never seen before, for as long as we have history for. And interestingly enough, the supply response after the peak in occupancies that we saw in 2007 to 2009 was not as dramatic as one saw in the mid-90s, when we also saw a peak in occupancy levels around the Rugby World Cup in 1995, etc. So the low occupancy levels we're currently seeing has been mainly a function of a fall off in demand and not a totally irrational, irresponsible supply response on the side of hotel operators. Looking at forecasted supply growth in hotel room inventory in the country for the next 5 years, the numbers are minuscule. With combining that with the better occupancy levels already being reported by the hotel operators in this country, we are quite excited about the level of the cycle, i.e. being very low, and that it looks set to be picking up as we speak. So this, we reckon, bodes well for the investment prospects of the businesses that we have allocated our clients' capital to. Then moving on to some businesses we have been decreasing exposure to. Two names which have featured prominently in that regard over the past year are Discovery and Omnia, both fantastic holdings, both stocks which we have had a long history with, or our clients have had a long history with, but both stocks which have, in this push into domestic industrials and financials by seemingly global money, the valuations have just reached levels where we no longer see very attractive risk and return prospects, and we have been decreasing exposures. Likewise, we have very limited exposure to the South African retail sector. Conversely, in our global funds, global retailers are some of our top holdings, most notably Carrefour, a global food retailer based in France, really. When we do the numbers and we analyze the companies, we come to the conclusion that on a normalized basis, one is paying about twice the enterprise's value to operating profit multiples for local retailers compared to what you're paying for global retailers. To us, that's a massive disconnect. It doesn't make a great deal of sense. Hence, we're steering clear of South African retailers and allocating capital to global retailers. On the fixed income side and yield side, the massively low interest rates we are seeing globally seem to be causing all kinds of irrational behavior. Chief amongst that seems to be the chase for yield into assets like property. And in the South African property sector, we're seeing prices at premiums to NAV in the range of 40 to 60%, which we consider to be phenomenal. We can see no rational grounds to justify such high premiums to NAV. These NAVs are marked to market NAVs, so they represent some measure of fair value. They're not historical cost NAVs as one would have with an industrial company. So for stocks in the sector to be trading at 40 to 60% premiums to that NAV strikes us as being totally inexplicable from a long-term value point of view. The only reason we can see why people are chasing after assets priced so highly is because of the somewhat better yield they offer than what one is getting in the bank. But unfortunately, this chase for yield appears to be driving people into very expensive assets, and we think that bodes ill for the long-term prospects of investors in those asset classes. So on that note, we're very excited about the prospects of our resources exposure, specifically platinum, and investments in the gaming and hotels industry, and we're steering well clear of sectors like South African retailers and also yield assets like bonds and specifically listed property.